Hi, and thank you for your interest in hearing more about specialized insurance coverage for real estate investors to help you make an informed decision on your portfolio needs. My name is Karen Henry. I'm the Vice President of Marketing for Breckenridge Insurance Group, and we're pleased to have this opportunity to be working with the team at Monday Morning Markets to bring you this helpful product knowledge video. Joining me today is Tom Elder, Senior Vice President at Breckenridge Insurance Services and an expert in real estate investor insurance, having been a program underwriter and broker focused just on this space for nearly 2 decades. Welcome, Tom.
Well, thanks, Karen. It's great to be here and share a little bit of knowledge about this very specific class of business.
So, Tom, property insurance itself seems pretty straightforward, but I understand that investors and related business owners may have unique and more involved needs to protect their investments best. What is it exactly that we're talking about here?
Sure. As opposed to just a standard homeowner's policy or a rental policy, we're talking about a comprehensive program to cover the specific risks that are going to be associated with investing in or owning schedules of real estate, combinations of right coverages and the utilization of technology. That's going to help these type of investors minimize the workload and some of the costs that's going to be associated with managing the insurance on a portfolio of real estate.
Okay, so who specifically would benefit from this type of insurance coverage?
It's kind of a broad brush. I mean, you're talking about individual investors, investment entities. These would be LLCs, formal corporations, LLPs in some cases, property management firms. These would be the management companies that are obligated through contract to procure and maintain the insurance as part of their duties. You have receiverships, and that could be both bankruptcy receiverships and foreclosure or foreclosure receiverships, private equity funds, publicly traded REITs, real estate investment trusts, or anybody really that has large schedules of properties that they need to manage in a convenient and appropriate manner.
Wow, that is a diverse audience. What would you say among those individuals or those owners of businesses is probably the most important thing to consider when looking for this kind of coverage?
That's the million-dollar question. Some would say it's price, some would say it's technology, but I'm going to tell you neither one of those are the most important when you're talking about this class of business. It is coverage, and you have to make sure that you have your investments adequately protected, especially if you have a fiduciary obligation, such as a private equity fund that has raised capital for investors and they need to properly protect this investment.
So can you elaborate a little bit on that?
Yeah, a lot of carriers use low rates and technology as a sort of a smoke and mirror approach to hide gaps in the coverage forms that they have. There's 2 sayings that you need to remember. You get what you pay for, and if the deal's too good to be true, it probably is. You need to read the forms, you need to read the coverage. Remember, the reason that you're buying insurance is for coverage and protection. So those losses that you have could be catastrophic, and you want to make sure that the proper losses are covered.
And I can imagine if you're in certain coastal areas as well, it's probably a little bit more complex of a risk. Is that something that you run into a lot?
It is. So if you have a risk that has a large number of properties in coastal Florida or coastal Texas or any of the coastal communities, you want to make sure that you have the proper coverages if a hurricane rolls in. A lot of companies in certain areas are stripping down coverages on hail coverage or wind damage or things like that. So yeah, it's very important to know where your properties are and what the risk is associated with those properties being there above the normal
Great.
risks.
That's definitely important. You mentioned gaps earlier when talking about just comparisons to other programs and things that might be available to this audience. What are those overlooked that you see based on your experience?
That's a great question. Some of the most common ones to get to price reduction, some of the most common property gaps you'll see are vacancy provisions built into the policy where if the property is vacant for more than 60 days, you're going to lose a percentage of your coverage overall, and you won't have theft and vandalism coverage. And theft and vandalism in particular is a very important coverage to have because that's where 75% of the smaller nickel and dime losses come from in this class of business. So you want to make sure that if you have to adequately protect that and you have a lower deductible plan, you want to make sure that theft and vandalism is covered. Loss of rents is a big one. If you have income coming in from this property and it then becomes unrentable due to a loss, you want to make sure that that income is protected so that your company can still remain viable in its investment endeavors. The other side of it is the general liability. These are the most important because these can be the most expensive. Assault and battery, if you own properties and someone is assaulted on that property, you do have some liability that you want to make sure that you're protected from. And the other is policy aggregate limits. A lot of policies are $1 million per occurrence, but they have a $2 million aggregate per year per policy. So that means if you have 100 or 200 properties and you have a lot of GL losses that go really high, somebody slips and falls, somebody falls down the steps, it happens, you are capped at $2 million for that entire portfolio for the year. So you really want to determine your needs on the GL side. You want to look for a policy that may be able to offer you a per location. Each house has a $1 million with a $2 million annual aggregate with no policy cap. Those are, in a lot of cases, that will help you avoid excess. But if you can't find a policy that can offer that, then you want to maybe look at some excess GL coverage to increase the amount of annual coverage that you have.
That's great advice. Just going back to price for a minute, what is your opinion of where that fits in kind of the cost-benefit analysis?
Yeah, to say price isn't important would be kind of an overstatement. Price is always a relevant part of the conversation when choosing insurance, but it can't be the primary driving factor. You know, an investor has to look beyond the obvious premium amount to see if it's a better cost. And some of the things that a lot of times aren't taken into consideration is the fact that you are moving into a master policy from an individual homeowners or dwelling form. Some of the costs associated with that, we would encourage that an investor perform a cost analysis and say, what is the insurance truly costing us? Not just one rate is 30 cents and one rate is 40 cents. What's the time invested from your staff to manage 100 policies? If you have 100 properties, to manage the renewal dates, to manage the cancellations, to manage the return premium tracking, all of those things have to be taken into consideration because somebody has to do them. Your time to manage that process, and of course, if there's any systems in place to help manage that process, there's likely a cost associated with that as well. That would all be in the cost of insurance, which a program could eliminate a lot of that and roll that up into the actual insurance costs.
Indeed, costs are key then. How do insureds help control some of their costs?
Well, aside from staff time, system costs, things like that, there's other ways they can control their program costs. Again, an insured or an investor should look for coverage first. What coverage do I need? And then the secondary conversation is how can I get the coverage that I need for the price that I can afford? And there's a couple ways they can do that. Higher deductible options. If they're on a standard homeowners or a dwelling protection form now, they probably have a $500 deductible. If they're an investor, they're probably willing to assume more of the risk up front than just $500, and they should consider that. They can take a higher deductible starting at $2,500, going all the way up to $25,000 to $50,000. So they can consider that to drive the premium costs down, but get better coverages than trying to keep that super low $500 deductible. And the second way is it's called an SIR, or a self-insured retention. And this is where some of the larger investors, where they have 200 and 300 and 400, 1,000 properties, they can determine that we're willing to accept a certain dollar amount of the risk each year, say $250,000 to pull a number out of the air. And when there's losses, they would pick up the first $250,000 of losses in any calendar year. A simple analogy to this would be like a high deductible healthcare plan where you have to pay your deductible, and once you meet that, then the healthcare would kick in. This is a similar type thing. You would hit that $250,000, and then your insurance would kick in above that. So, assuming more risk that way and saying we're willing to take on that first $250,000 can significantly reduce the insurance cost and get better coverage.
That's a great analogy and great tips overall. Before we let you go, are there any closing words of advice you have for these folks seeking the real estate investor coverage that they really need?
Yeah, absolutely. Although cost is important, don't consider cost first. Make it part of the conversation, but make sure that you're getting the coverages that you need. That's first and foremost. That's why you have insurance. Remember that sometimes it does make sense to assume more of the risk and take a higher deductible, either through a higher deductible option or even a self-insured retention if your schedule is big enough. And remember, some of the coverages, it could be a calculated decision to forego some coverages to save premium. And a good example of that would be if you have a $25,000 deductible and you have theft and vandalism coverage. A typical theft and vandalism claim is going to come in under $25,000. You may decide, well, what would my insurance cost if I didn't have theft and vandalism on there, because I'm typically going to assume that risk in most cases anyhow. And lastly, I think the most important thing above getting the right coverages is finding an insurance agent that's very knowledgeable in this class of business that can help walk you through determining what coverages and what exposures you have, getting the right coverages in place, and then working with you to get the right costs associated with that. And I think that a professional insurance agent that understands the class is vital to accomplish all those goals.
Well, fantastic. Thank you, Tom, for sharing your insights and experience with us today, and thank you to Monday Morning Markets for this opportunity. We appreciate those who've joined to take a listen, and know you're busy, so we just really appreciate it and really do want to encourage you to talk to your insurance agent to find the best solution to fit your needs. Thanks so much.
Thank you.